Want to know how I made money on a purchase of a house and then I made another $120,000 on the property keeping it? Let's break it down. So first, what you gotta do is you gotta be able to buy the property. Vlada's gonna break down how you're gonna buy the property.
The first thing, and probably the easiest way that you can buy a property, is go on MLS, go on Zillow, and buy on market with a realtor. You can also partner up with a realtor in your local market or wherever you're trying to do this in. Tell them exactly what kind of criteria you're looking at to buy, what formula you're trying to use, what you're trying to do with it, and they should be able to help you get the property that you need. Another way you could do it is buy from a wholesaler like myself. You definitely do want to tell us your buying criteria, where you're looking to buy, what you're trying to do with it, because depending on the kind of investment you're trying to use, we might send you slightly different deals. Something else that you can do is you can find a motivated seller and do this by yourself, but it does take a little bit longer. And the way that you could find a motivated seller is essentially foreclosures, expired listings, absentee owners who it's a little bit easier when they're out of state, probates, tired landlords, you could just drive around the neighborhood, high equity lists, divorces. And the way you would actually start reaching out to them is door knocking, cold calling, texting, mailers. It does take a lot of work. It does take a lot of follow-up. So probably easier to go with a realtor or the wholesaler option because we do this work for you. Next thing that you're going to do to buy the property is you got to decide what you're trying to make on it. The typical formula for this would be you would calculate the after repair value, 30% discount for your holding costs, but I think you guys are going to go into this a little bit more. Minus the rehab is the max offer that you can make. For doing this, you would also need to double check what the rent is going to be when you do fix it up and then collect your equity out. You do want to make sure the rent comps are there against your out loan. Honestly, probably the best way of doing this is reaching out to a local realtor in your market to give you the most accurate rent comps for the closest radius for the exact condition that is your property. But a good starting point to do it by hand is Rent-A-Meter and then start looking on Zillow. So let's say something listed for rent for like $1,400 a month and it's been listed for 50 days, probably way too high. So you got to see what's selling, what's moving as quickly as it is. And that will show you roughly what your rent should be.
Once you find that property, what you're gonna do is you're gonna have to renovate it after you already purchased the property. We kind of went over this last week. I'm gonna give you a quick story of a property that I found back in 2018. My partner and I, we purchased it directly from the seller for $106,000. From there, what we did was we figured out what we needed to do on the renovation. We came in, we renovated the property for about $65,000. Once we had it finished renovating, we were able to find tenants. This was a 3-family, so we found 3 tenants. They were paying $950,000, $1,250, and $1,350 at that time. Once we got those tenants in there, we were able to get a new bank to come in and refinance us. That property appraised for around $380,000. From there, we were able to cash out about $114,000. So that's how I was able to make close to $120,000, like I was saying earlier. Some of the things you want to look out for in the property is the neighborhood, right? If you want to find the correct neighborhood to do this, you want to also be able to use, depending on the neighborhood, types of different products. For example, if you want to use cabinets for a cheaper neighborhood, you want to just use, let's say, a white shaker cabinet with a cheaper quartz countertop. I typically do not ever use laminate countertops anymore. Quartz is a little bit better in terms of stability, and also it may cost you a few dollars more though. What you want to do is you want to get, let's say, a home inspection and make sure there are no roof leaks anywhere. Next big item would be your HVAC, heating and cooling. It's okay if you don't have cooling necessarily, but you want to at least have heating, right, for the house. Then you want to make sure all your plumbing is intact, it's not leaking, there's no active leaks. And if you do have any type of leaks, you want to make sure you get that fixed. Then you want to make sure in your bathrooms and anywhere you have tile, make sure those are nice and tight as far as the bathroom go. And again, no leaks there. Everything else is cosmetic and can be fixed over time. I want to pass it on to Joe, who is going to explain to us a little bit about the numbers. What kind of numbers are we expecting as far as purchase? We have two purchases in this type of scenario, right? When we initially purchase the property, we have to either come up with our own money, or we can get some private money, which we can explain in another episode. Let's say for now, what can we expect numbers wise if we did a purchase through, let's say, a hard money lender?
Yeah, so two of the most popular ways to purchase a property right now, well, three, you can use your own money, which is not very smart to do right now. You can use private money, right? They're going to fund it. They're going to help you with the construction. They're going to help you with the purchase of the property. Or you could use hard money, which is essentially like private money, just a little bit more hand-holding because they're more experienced lenders. They normally have construction background. They've done thousands of these types of deals in the past. So I normally suggest go with a hard money lender. So that's for your purchase. Once you have your purchase, like I always say, I'm the third R in the BRRRR, right?
Yes.
Which is a very niche word out in the industry right now. And it's actually the easiest way to make money, like we said before, make money while making money. What happens on the third R is you're going to refinance out the property. You're going to take out the equity that you've built out during the process of the construction, and you're going to take that equity and you're going to pull out a certain amount, usually up to 80% between the after repair value in which you actually purchased the property for, all in. You're going to take that money and then you're going to use that to now fund your next deal. So that's why we call it making money while making money, because while you're pulling out that cash, you're also renting out the property at the same time. So it's double the amount of money that you could be making at one time. What a lot of people don't talk about is how does a DSCR loan, which is what we would always recommend right now to actually hold these properties like a fixed loan. Instead of doing, let's say, like conventional 3.5% or 5%, DSCR loans, you're actually allowing the rental income to qualify you for the loan. So let's say you bought a house and now it's worth $200,000, and that's how much you're going to take out a mortgage on it. And the PITI, which is your principal, interest, taxes, and insurance, is going to be $1,000 a month. What you want to do is stay above that number. So as long as the total rental income, whether it's a single unit or up to a 4-unit or an 8-unit, is at least $1 more than the actual PITI number, you're most likely going to qualify for this property. There are ways where you can do a negative DSCR loan, but at that, it's a little bit riskier loan for the bank, and you're probably going to have to put at least between 30 or up to 40% down sometimes for that type of loan.
Awesome. Some good information there.
Joe, what's a DSCR loan? What does that mean?
It's a debt service coverage ratio. So basically, the debt on the property is going to actually help you qualify for the loan. Mortgage is $1,000. Your rental income is $1,500. You qualify. And it's a lot less documentation. You don't have to provide W-2s. You don't have to provide tax returns. They do normally suggest that you are at least a homeowner, have a minimum, let's say in today's market, a 660 credit score, and between 20 to 25% down. And now you got a 30-year fixed loan where you're putting up a lot less of your information and you're using the rental incomes to qualify you for the loan.
I got one more question for you, Joey. So you pulled out roughly $120,000 after
right.
doing all the renovations and then putting a tenant in there. But were there any other costs that someone should probably be aware of if they are doing this?
Absolutely. First thing you have to be mindful of is the realtor costs. That's going to be your biggest cost up front, or your, let's say, wholesaler. How did you find that property? Those are going to be your biggest costs up front, either realtor, wholesaler, some type of referral fee to get into the property. That's probably going to take anywhere from, let's say, 5 to 6%. If it's a realtor, wholesaler, there's a huge range in terms of wholesaler. I've purchased property as low as, say, $1,000 and as high as, I believe, about $55,000 from a wholesaler. So there's a huge range in how much they're going to be asking. Then the next cost is going to be a lot of fees, just the closing costs. So you're going to have to address all the different closing costs to get into the loan, the initial loan. So you have to account for that. You have to account for the second refinance loan as well. So you got to make sure you account for both loans. As far as closing, there are other fees, right? You have the initial appraisal. Usually appraisals for a residential property, how much would you say that would be?
About between 3 to 4%.
3 to 4%, okay. And then after that, you have to account for any types of holding costs. Don't forget attorney fees. An attorney, you can go as low as I've seen about $750 to roughly about $2,000 is going to be your standard attorney fee in a smaller residential deal. Then you have your title costs. That's going to run you, again, anywhere from about $1,800 to about $3,500 depending on the company and what's covered. Then you have mostly holding costs after that, right? You have to, let's say if you have a homeowner's meter for electric, you got to pay that. For the gas, the homeowner's common area, we call it, you have to pay that as well. Any type of water or sewer costs, you have to pay for that as well. If you have any type of like security camera, things like that in the property, you're going to have to pay for that. And then you might even need to get Wi-Fi. So that's another thing to think about. Not everyone does it. So a lot of people forget their maintenance, right? And then vacancy as well. So typically you're going to have some vacancy between tenants. So a lot of time people put in a percentage. I don't always put in a percentage. I usually put in, let's say, a 1 or 2 months of whatever the most expensive unit cost is. So from there, you're going to have the property taxes, which, you know, never really goes down. I do recommend, though, annually doing a tax appeal. That'll keep the raising rates of tax down as much as you can help it. So from there, those are all your costs you have to add up. So it's not as simple as we kind of say it is. So I would recommend having a spreadsheet, and if anyone is interested, I can share my spreadsheet with them to be able to input all their costs. On the refinance side, you can do either a DSCR loan or you can do a conventional loan as well. Conventional loan may have a little bit more in terms of cost and time as far as paperwork is concerned. So you have to keep that in mind. How quickly do you want to refinance? So those are some of the costs associated with it.
And piggybacking off costs, another thing that a lot of people don't talk about with the DSCR loan, there are soft costs, which are your reserves. A bank is going to look for at least a minimum of 6 months reserves. Doesn't necessarily mean you have to shell out that money. They're going to go through your bank statements to make sure that you have at least 6 months worth of mortgage payments.
If anyone's looking for more information, give us a shout. So guys, thank you so much for watching, and we'll see you next week.